Let me be completely honest with you right now. Most retirees are unknowingly handing the IRS thousands, sometimes hundreds of thousands, of dollars more than they legally have to. And the frustrating part, it's not because they did anything wrong. It's because nobody ever told them about this one simple concept that completely changes the game in retirement. So stay with me for the next few minutes, because what I'm about to share with you could literally save you more money than any investment decision you've ever made. And if you're new here, welcome to Retire Smart, the channel where we help you keep more of what you've worked your entire life to save. Hit that subscribe button right now, because we put out videos every week that are specifically designed to help you make smarter, more confident decisions in retirement. All right, let's get into it. Here's a question I want you to think about. What if the biggest financial advantage you have in retirement has nothing to do with the stock market, nothing to do with Social Security timing, and nothing to do with which financial products you buy? What if the single most powerful thing you do to protect your wealth in retirement is something the IRS absolutely cannot take away from you, and most people don't even realize they have it? That advantage is income control, the ability to decide how much money you take in, where it comes from, and when you take it. And in retirement, unlike during your working years, you actually have this power. The question is whether you're going to use it, or let it slip away without ever knowing what you had. Let's back up for a second and talk about why this matters so much. When you were working, your financial life was pretty rigid. Your paycheck showed up every 2 weeks. Your taxes were withheld automatically. Your employer made most of the decisions for you. And sure, you could do a few things to soften the blow, contribute to your 401k, put money into an HSA if you were eligible, maybe give to charity and deduct mortgage interest, but beyond that, the levers you could pull were pretty limited. And let's be real, even itemizing deductions used to be a meaningful strategy. But since the Tax Cuts and Jobs Act back in 2017 nearly doubled the standard deduction, over 90% of taxpayers now just take the standard deduction because it's simply more generous. Right now in 2026, you'd need over $16,000 in itemized deductions as a single filer, or over $32,000 as a married couple, just to beat the standard deduction. Most people can't clear that bar. So during your working years, your tax situation is largely out of your hands. You're playing defense, but retirement is a completely different ballgame. And this is where things get really exciting and really important for you to understand. Once you stop receiving a paycheck and start living off your savings, something fundamental shifts. You are no longer locked into a fixed income number. Instead, you get to choose. You get to decide whether to pull money from your traditional IRA, your Roth IRA, your taxable brokerage account, or some combination of all three. You get to decide how much to take from each bucket in any given year. That flexibility, that control, is worth more than most people realize. And it's the foundation of every smart retirement tax strategy out there. Think about what that actually means in practice. In a low-income year, you might intentionally live off your Roth IRA, where withdrawals are tax-free, and keep your taxable income as low as possible. Maybe that helps you qualify for a better rate on your health insurance through the Affordable Care Act. Or maybe it keeps you in a lower tax bracket, so you can do something else we're going to talk about in just a minute. On the flip side, in a year where your income is already modest, you might intentionally pull forward income from the future, doing something like a Roth conversion or harvesting capital gains on purpose, because you know your tax rate today is lower than it's going to be down the road. You're essentially shopping for the cheapest tax rate across your entire retirement, not just in any single year. And that's a fundamentally smarter way to think about money. Now here's the key thing I want you to lock in, because this is the core insight that separates the retirees who pay dramatically less in taxes over their lifetime from the ones who overpay year after year. The IRS thinks in 1-year windows. They look at your income from January to December of each year, and that's it. Each year is completely isolated from the next in their eyes. But you, Especially if you're a retirement saver with a healthy nest egg, you get to think across decades. You get to plan across 20, 25, maybe even 30 or more years. You get to decide the order of operations for drawing down your savings. You get to smooth out your income in a way that minimizes your lifetime tax burden. And if you have children or grandchildren you want to leave something to, you can even think about this multi-generationally. That long-term view is your single biggest advantage over the IRS, and most retirees either don't know about it or don't use it. This is especially important if you're what I'd call a super saver. Someone who has accumulated over $1 million, typically inside tax-deferred accounts like a 401k or traditional IRA. If that sounds like you, pay very close attention to what I'm about to say, because this is where the stakes are highest. When all or most of your savings is sitting in tax-deferred accounts, every single dollar you pull out in retirement is going to be taxed as ordinary income. And the longer that money grows inside those accounts, the bigger the potential tax bill becomes. You may have done everything right during your career, saved consistently, invested wisely, let compound growth do its thing, and yet without a deliberate plan for how to draw that money down, you could end up paying far more in taxes than necessary. Here's the concept I want to introduce you to, and this is really the heart of what we're talking about today. I call it the perfect RMD. Now, if you're not familiar with RMDs, required minimum distributions, let me give you a quick overview. The IRS requires that once you reach your mid-70s, you must begin taking money out of your tax-deferred retirement accounts every single year, whether you need it or not. It's not optional, it's mandatory, and those distributions are taxed as ordinary income. The amount you're required to take increases as you age, roughly 5% of your total IRA balance around age 80, climbing to about 8% at age 90, and over 15% if you're lucky enough to reach 100. And here's the critical thing about RMDs. They're basically guaranteed to grow over time, because they're calculated based on your account balance, and hopefully your investments keep growing. So what is a perfect RMD? It's actually a simple concept. A perfect RMD is one where your required minimum distribution is equal to or less than the amount you are already planning to withdraw to cover your living expenses. In other words, the government is only requiring you to take out what you would have taken out anyway. No forced extra income. No surprise tax bill. You're in complete control. Let me make this concrete with an example. Let's say you need about $100,000 a year to live comfortably in retirement. Around half of that, $50,000, comes from Social Security. The other $50,000 comes from your IRA. Now, if your RMD, when you hit your mid-70s, is anywhere under $50,000, you've got a perfect RMD. You're just naturally satisfying that requirement through your normal spending. Life is good, you're in control. But now flip that scenario. Same lifestyle, same $50,000 needed from your IRA, but your RMD comes in at $85,000. Now you've got what I'd call an imperfect RMD. The IRS is forcing you to pull out $35,000 more than you actually need. That extra income gets taxed. It can push you into a higher bracket. It can increase the portion of your Social Security that gets taxed. It can trigger higher Medicare premiums. It creates a cascade of financial consequences that most people don't see coming until it's too late to do anything about it. And remember, this problem tends to compound on itself, because the bigger your account balance grows, the bigger your RMDs get. If you're not addressing this during the early years of retirement, when you still have the most control, the window is quietly closing on you every single year. Now I want to address something, because every time I explain this concept, someone in the comments says something like, "Hey, if my RMDs are so big that my income spikes in retirement, that sounds like a good problem to have, and I genuinely understand why that feels true. But I want to respectfully push back on that, because I think it reflects a misunderstanding of what's actually happening. When someone reaches their 80s or 90s, and they're being forced to take out far more income than they need, Here's what that actually tells me. It tells me they probably had the opportunity earlier in retirement, when they were younger, healthier, and more energetic, to spend more money, enjoy more experiences, and live a fuller life. And they didn't, not because they couldn't afford it, but because they didn't have a plan that made them feel safe doing it. Think about the first decade of your retirement, your 60s and early 70s. You've got your health, you've got your energy, you've got the freedom of time. Those are your golden years in the truest sense. That's when you should be traveling, spending time with the people you love, doing the things you've always put off. If you end up in your 80s being forced to take distributions you don't need, while also looking back and realizing you lived too conservatively in your early retirement years, that's not a good problem to have. That's a missed opportunity. And avoiding that kind of regret is one of the most important things a smart retirement plan can do for you. The second missed opportunity that comes with imperfect RMDs is tax planning. Large RMDs almost always signal that the early retirement window, those precious first 10 years or so when you had the most control, was not used strategically, specifically. It often means that Roth conversions weren't done when they should have been. A Roth conversion is simply the act of moving money from a traditional IRA into a Roth IRA, paying taxes on it now, and letting it grow tax-free from that point forward. The reason this matters is that once money is in your Roth, it's no longer subject to RMDs. It no longer forces income on you, and withdrawals from it are completely tax-free for you and potentially for whoever inherits it after you. I know some people are hesitant about Roth conversions because they think, what if I don't live long enough to see the payoff? And that's a fair thing to think about. But consider this. Even if you personally don't benefit from the conversion, your surviving spouse likely will, because when one spouse passes, the other is left filing as a single taxpayer, which comes with smaller tax brackets and a much harder squeeze from the IRS. And beyond that, your children or grandchildren who inherit your IRA will eventually have to pay taxes on every dollar that comes out. So one way or another, those taxes are going to be paid. The only question is whether you pay them strategically during a window when your rate is low, or whether they get paid in the worst possible circumstances at the highest possible rate. The IRS is always going to be a silent partner in your retirement accounts. The goal is to make sure they get as small a share as legally possible. So let me bring this all together for you, because I want you to walk away from this video with one clear idea locked in your mind. The most powerful tax strategy in retirement is not a loophole. It's not a complicated scheme. It's not something that only wealthy people with accountants can access. It is simply this: maintain control of your income for as long as possible. Find the window in your retirement where your tax rate is the lowest. Use that window intentionally and deliberately to shape your income. Reduce your future RMDs and minimize what you owe the IRS over your entire lifetime. That's the game. That's what smart retirement planning is actually about. If you've been watching this video and thinking, okay, I understand the concept, but I'm not sure how to actually apply this to my situation, I want you to do 3 things right now. First, leave a comment below. Tell me where you're at. Are you already in retirement, or are you still planning? Are you worried about RMDs? I read every comment and I want to know what's on your mind. Second, share this video with someone you know who's getting close to retirement or who's already in it. This is exactly the kind of information that people need and most simply never hear. And third, make sure you're subscribed to Retire Smart, because we cover topics like this every single week. Practical, straightforward retirement planning content that helps you make smarter decisions with your money. Hit subscribe right now if you haven't already, and tap the bell so you don't miss a single video. Your future self will thank you.